Welcome to Long Story Short, a podcast where two financial advisors, one rooted in financial planning, the other in investment strategy, break down the questions we're actually hearing from our clients. Each episode, we tackle one or two real-world issues that matter to high-net-worth individuals, from market-moving news to personal finance decisions with lasting impact. No jargon, no fluff, just clear, thoughtful insights from the front lines of wealth management. We keep it short, but we don't cut corners. This is Long Story Short.
Okay, so this is the second formal shot at Long Story Short. And last time we did this, which was a week ago, it's amazing how much and how little changes in a week. But you blindsided me when we started recording and you asked me a question. And what you asked me was, what was my favorite TV episode pilot? And I said, Sopranos, you said Lost, and we felt pretty good about our choices. And now it's my turn to throw you the proverbial curveball out of the gate and ask you in the spirit of the first day of summer being this past weekend, what is your favorite summer? Summer doesn't need to be in the title, and it doesn't even necessarily have to have been released in the summer, but what's your favorite summer-ish themed song?
Right.
And why?
Yeah, no, like I hate it when they force this is the song of the summer thing, right? Where it's the radio DJ. I remember the Killers released an album and their song The Man came out, and the DJ on my local rock station was like, "This is the song of the summer." And I love the Killers. That was not the song of the summer though. So if you're telling me like song of the summer, I still think it needs to be like released kind of a rap. It needs to be the thing that summer. So I think "Good as Hell" by Lizzo for me is on that list. It was like a couple summers ago. I feel like that's what we listened to constantly.
That was unexpected.
My family has a house on a lake. No, but we were playing that song while surfing on Lake Anna just over and over and over again.
Okay. I would not expect
my other answer is yeah. Yeah, it's not normally my like genre of music, but I mean my other answer was "California Girls" by Katy Perry from like 2011.
Okay.
I'm sure you love that one.
I'm gonna say no, but I'm glad you do. It's the beauty of music.
Sometimes it can feel forced though. Like Weezer has that song "Feels Like Summer." You know, I think it's too forced.
Yeah, that's hard. That's hard, but you know, sometimes it works. But you know, it's all a matter of personal preference. That's the beauty of music, right?
Right. Well, I know you play. Are you going to be releasing a summer hit?
No, we are not. We are our finance themed rock band is going to take a little bit longer to release our music.
I think the people need to know that you are in a rock band.
I would say some do, some don't. We like to keep it a little bit of a mystery, but Swimming Naked, the band's name, is on a bit of a long trudge to finish recording. So I can't say we'll make anyone's song of the summer list this year.
Maybe next year, huh?
That's the plan.
Yeah. Well, I'm not sure quite how to segue out of this, but we did launch this podcast not to talk about pop culture, but rather to talk about the things that clients are asking us that might or might not affect their portfolio, right? So there's probably two big storylines that we're going to cover today. You know, the one that I want to start with, though, you know, I know this is a question that you've been getting, is the new tax bill has passed the House, bounced back over to the Senate. What is the status of that tax bill, and then what are the potential impacts that might affect people today?
So the big, beautiful bill, as they coined it, actually the Senate did release their version last week. So both the House and the Senate's versions of the big, beautiful bill have been reconciled amongst themselves, and now they need to come together and handle the differences between the two and come up with something ultimately that the president can sign. So the status is that now they get to form a committee and work amongst themselves to look at the House bill, the Senate bill, and come up with some sort of a consensus that they're all okay with. And the plan the goal was to get that done by July 4th. I don't know if anyone can say definitively if that's going to happen. There's still some big roadblocks, which are there's a handful which exceed the length of time we want to discuss this on a podcast. But um, essentially, what it boils down to is the House version of the Big Beautiful Bill is uh, it's larger. Number one, it's a little more liberal in the tax cuts, meaning there's heftier cuts underneath the surface. So there's some more aggressive tax proposals in the House version. The Senate version is a little more meant to be a little more, I'm using air quotes here, budget friendly, um, less sizable cuts, but still some pretty meaningful stuff. And both raise the debt ceiling by several $1 trillion. So neither are really thrifty, so to speak. But the Senate version, you had some more of the budget hawks in there trying to rein in some of the spending. So they've got to reconcile it amongst themselves. And I think the key for here is to focus maybe on the things that'll overlap to most of our clients. Like, what are the things that are in both of the bill, both the House and the Senate version, that are likely to pass through in some way, shape, or form that probably impact the broadest range of our clients. Um, and the big key theme is that the tax rates that have been in place since the Tax Cuts and Jobs Act was passed back in Trump's first term are extended in both versions. There's some minor differences in how the inflation adjustments are handled, but in general, the tax rates as we see today, they'll be extended into the future, which is, that's some certainty there, which is a plus. The second thing is the estate tax exemption. And actually, both the House and the Senate version goes up to 15 million per individual. So 30 million if you join forces as a couple. That's a
We talked about that a lot
yeah. That's
in the leading up to the election, right? That was a common
yeah.
question.
People were worried that the estate tax exemption was going to sunset back to what it was, which would be about half of what it is now, and it's actually going up most likely in the Big Beautiful Bill. So that's for estate tax purposes, give people a lot of breathing room. And I always say this: estate tax revenue is always very minimal in the context of the federal budget because there's a lot of creative ways to skirt around it. So it's only ever been the low single digits percentage of the federal revenue because people can get creative and do things to avoid estate tax. That's the second thing. And the other two items that are of note that people have been talking about is the SALT tax, state and local tax. That was a big pain point in the Tax Cut and Jobs Act, capping state and local tax if you itemize deductions at $10,000. And that's whether you're an individual or a couple. So if you file joint, it's almost like you get penalized for that because it's not double the deduction. You still are capped at the 10K. The House version, it actually lifts that up to 40 grand, and with some income limitations, but they do give some breathing room on state and local tax deductions below certain income levels. And in the Senate version, they still cap it at the 10,000. So that's like an item that for people that itemize, which most of the country doesn't itemize, but a lot of our clients do. Those that itemize deductions, that'll be interesting to see how the House and the Senate, which of those two kind of win over in the final version. That's a big one. And then for business owner clients that are pass-through entities, the QBI deduction, which is 20% of pass-through income, it looks like that'll preserve itself through either version, but the House version actually kicks it up a little bit to 23%. So that's another, for a lot of our clients are business owners that operate as pass-through entities. That's another really generous deduction that a lot of our clients get to take advantage of. It looks like that'll make it through. So those are some of the big items that are there and are in in some way, shape, or form in both versions, and it's just a matter of seeing what comes out at the end. So we'll keep an eye on it and want to figure out what kind of tax planning opportunities might present themselves, but it's a matter of whether it happens in July or like it did last time at the 11th hour at the end of the year. So you can you can't bank on a lot of certainty, but when it comes to government, things tend to get drawn out to the last minute. But I think overall more
You never
spending,
know.
right? The debt. So those that are concerned about debt and the debt clock, so to speak, of our many, many trillions of mounting debt. Neither version of this address that. And it's just, regardless of who's in office, it's just a little more spending on top of more spending, right?
Right. Yeah. And that's a question that I actually got last week was around the deficit spending, right? Like at what point is it too much? Even safe investments like treasuries, like at what point do we need to worry about those? My sense is that we're not at that point yet, but I'm curious, Adam, how you would respond to someone who is asking about the deficits, the possible impacts from this bill on the deficit and financial markets.
So I think anyone that says they know with certainty how our current debt situation is going to translate into the economy and markets is, that's you see it all the time. The buzzwords, and you get ads on Facebook or on CNBC. You see people posting about, the debt bomb is ticking and it's going to mean catastrophe for the markets. But anyone who knows what that looks like in practice is making a wild guess. The reality of the situation is, and this has been, I mean, I know the numbers have gotten larger, but this has been a problem for a really long time. And we've kind of always shrugged it off. The economy has gotten more efficient, it's gotten stronger, and corporations have gotten more profitable even as our debt has spiked through time. So, like, is our economy better today than it was 15, 20 years ago? You'd say yes. I'd say yes. Most people would say yes. And through that whole time, our debt situation has gotten worse and worse. So, I mean, just like the dots haven't connected yet. And also,
Yeah.
we're still that we can keep printing money as long as the dollar is like still the go-to reserve currency of the
Yeah.
world. And like,
Yeah.
what's going to overtake
I think a lot
that
of,
right now?
yeah, right. I mean, people say China all the time, but are you really going to go there to have a reserve currency? I don't know if that's going to actually happen. But yeah, no, I think the thing that people oftentimes don't understand is like a government, like the U.S. government that prints its own money, is not like a normal household or a company where like you can go into bankruptcy, right? Like a government can't. As long as you can print money, you really can't, right? You can default on your debt, and it's actually I think good to see the debt ceiling raised in these bills. I'd love to see the debt ceiling thrown out the window altogether, actually, because it doesn't accomplish anything. It's the spending's usually agreed to ahead of time, and then the debt ceiling's lifted later. But the impacts of like if government deficits got to a point that was concerning, you would begin to see that in the inflation data, right? And inflation, even with the tariffs, is still coming in below expectations, right? The inflation that was from 2022 wasn't due to the deficit, it was due to supply chains and things like that, right? So it just seems like this is one of those things people love to talk about. People love to fearmonger on with the deficit, but I really don't think it's something that should be impacting anyone's allocation
You should
decisions.
not make investment decisions based off of it. Is it an alarming number to see on paper? Yes, we all agree on that. Is it something that could potentially have to be aggressively addressed in the future? Sure. Yeah, like, right. And what does that look like? We don't know. But the reality is a lot of market returns have been generated through our mounting debt. And it might not necessarily be like an investment consideration we need to worry about right now. And yeah, and the whole notion that like printing money equals inflation is it's been debunked since the bottom of the financial crisis. I mean, we were at zero rates printing money for many, many years, and inflation was like, below 2. It was like 0 through most of that. So
Mhm.
yeah, I think you hear it a lot when you turn on the television. It is something to factor into maybe like long-term planning, but I just don't even know what you do, because the idea is that the market generates returns over time that are tied to corporate profits, and I don't know how the debt ceiling or our level of debt connect to that in any way. But
Mhm.
but there is
Well,
something else.
well, as you
Yeah,
said,
we talked last time about. I'm going to turn it over to you on this next question, because I like this one. Extra timely, um, with everything that's mounting over in the Middle East. When we did our last episode, tensions with Iran were rising. Iran and Israel were trading fire pretty regularly at that point, and then over the weekend we got involved, and uh, overnight essentially went over to Iran, attacked some of their nuclear sites, and flew back all in one swoop. And so that definitely raised the temperature and had a lot of people guessing what was going to happen when the markets opened today. And let me check here. Yeah, we're still green. So just as you'd expect, right? Markets rally
just as you'd expect.
on the U.S. dipping their toes in a Middle East adventure. So we got a lot of good client questions about this. So in general, how do you anticipate that this escalation in Iran is going to impact the markets?
Yeah. Yeah, like where were you when you got the push notification on your phone over the weekend? I think most of us were just enjoying a cookout or at the pool or something, and we're getting bombarded with this news. So yeah, I mean, I think this is something that was the market knew this was a possibility, right? No one really knew if it was going to actually happen or how quickly it was going to happen with the U.S. specific involvement. But Iranian-Israeli tensions have been, mounting for a while, and with all the tough talk out there, it was only a matter of time before, some bombs were tossed at each other. But yeah, I think getting that push notification over the weekend, my expectation was, all right, markets are going to open down. And when by the time we got to the futures markets opened, they were red, but it really wasn't that bad. And then I got the most hilarious push notification, I think, just a few minutes before we actually started recording today, and it was the Dow jumps more than 200 points as oil drops following a restrained retaliation by Iran. So now we're talking about like a retaliation happened. That sounds bad, but it was restrained. So the stock market's up, right? You can just never predict these things.
Yeah, that was like one of the
And I
things where they
and I
like
can
called up everybody before they did it, and they're like, "Hey, we're gonna do this, but we don't really want to cause any damage or kill it. Like, we have. It's almost like we kind of have to do something to retaliate to save face, but here's when we're gonna do it. Uh, we don't really, we're not trying to escalate it. Just let us do our little retaliation. That's what happened in 2020. Under not the exact circumstances, but the same thing happened with them 5 years ago, and they did a retaliatory strike that was kind of like a little bit of theater. But I saw a great tweet, Ryan Dietrich of Carson Group, pulling it up now. Um, Stocks rally, dot, 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 as this is just a global bull market. Not the title you'll read today, but sums it up more than anything. And that's just about it, right? We keep going back to tuning out the noise, thinking about what drives stock returns over the long run, and how in most all recoveries, we just had a 20% sell off in April. Every time the market recovers, you're just looking for reasons to scare yourself out of it.
Well, and there's no shortage of those reasons, right? Those are being hurled at you constantly through these push notifications and things like that. So, I totally agree with everything you said there, where this is not something that should be impacting anyone's decisions as far as how they allocate their portfolio or what they should do with their portfolio. But one of my the things that I just get a chuckle out of every single time we get there's always a new thing that's the uncertainty that's supposedly driving stock market volatility. And a while back, like in 2022, the word was stagflation, right? We had to learn what stagflation meant. It'd probably been a decade before anyone ever, heard that word. And all of a sudden, we're all experts on stagflation. Now, we're all experts on the Strait of Hormuz, or I don't even know if I'm saying that correctly, right? It's this narrow strip of water where a bunch of crude oil, travels right on its way out to being exported. So now that's the big thing that we all need to be experts on, right? And I just get a chuckle because none of us need to be experts on these things, right? Like this is news. Maybe it's good to be up on what's happening in the world, but the link between that and your portfolio, it's tenuous at best.
Don't forget the yen carry trade, right? We've gone from the last few years we've been banking experts with what happened with Silicon Valley Bank. We've been yen carry trade experts. Now we're Middle East oil supply and political dynamic experts.
And look, I've played my fair share of Risk. I love Risk. It's a great game. So I know, strategic spots on a map.
Well, then I'll let you make the investment calls on timing this. But no, seriously, I mean, this is what happens, and I say this all the time. You go back to, and while I'm saying this, I'm going to pull up a chart that I want to reference that I think is going to be kind of interesting despite all this happening. But you go back to 2009, 2013, 2020, 2022, all these times when things, get, there's volatility and the market sells off, and then there's this recovery window, and it just feels scary. Most of the recovery feels scary and uncertain, and you've got to, and it's never in hindsight looks like, I'm sorry, in hindsight it looks like a good decision, but in the moment it never feels comfortable. So while all this is happening, and we've got this the tariff sell-off, we got what's happening in the Middle East, quietly behind the scenes, there's two things I want to reference that I think are speaking to just like the market rally in general and what's happening and why. So year to date, as of I think Friday's close, if I look at the S&P 500, it's up 1.5% ish. So back in the green after a big almost 20, pretty much 20% sell off in April. Back, in the positive, but slightly. If I extrapolate that out and I look at the Mag 7, the tech stocks that are supposed to be driving all the returns in the market, that's the argument we've heard the last couple of years as well. The market's not doing well. It's just Apple, Amazon, Google, Facebook, Nvidia, Tesla, right? It's just the hot, high-flying stocks. Those are actually down 3% this year. So the S&P is up 1.5%. They're contributing negatively to that 1.5%. They're down collectively over 3%. The other 493 stocks out of those, Mag 7, the Magnificent 7, are up 4.25%. So the market is getting, you hear the term breadth and broadening, but that's actually what's happening, right? And you've got to be seeing that, Andy, within our stock selection and, at the individual company level. That's something you're seeing that's just like significantly different than the past few years?
There's a lot of opportunity there for sure. One of the things I like to track is the S&P 500 against the S&P 500. So with the one version of the S&P 500, it's market weight. So the biggest companies have the most weight. And the other version of the S&P 500 is equal weight. So every single stock gets the same weight. In the past couple years, the storyline has been the market cap S&P 500's been beating the equal weight version by 10 plus percentage points, like both years, 2023, 2024. This year, that's flipped, right? So the equal weight version has outperformed the market cap weight version, right? Which, again, that's the story of market breadth. And I think when it comes down to, picking stocks, right? Like it's easy just to pick Nvidia and Microsoft and Apple and own that. And it's been great that for years that part of, the market's been doing well because it means a lot of people have made a lot of money. But those biggest companies oftentimes underperform the market as a whole, right? It's typical to see the equal weight version outperforming everything else, and so this could be the start of a longer term
Yeah,
trend.
other companies are joining the party, and I think from here, and I think just really quick, I mean, acknowledging the fact that things do come out of left field, and there are outliers and surprises in any kind of market environment. You don't ever want to invest based on that because the odds are against you, number one. And number two, timing is really hard. And you have to think long term and stick to the plan. But literally, I mean, if you slice and dice the current environment we're in, take out all the noise, um, most of the forward looking indicators, if I go back historically in similar environments where you've got, you know, a certain amount of companies making new all time highs, X percentage off a new all-time high, a couple percentage points off a new all-time high for the S&P, even lower than that probably after today's close. Whenever you get in a broadening of the market, when you see those factors collide, the forward-looking returns look really strong. And you can bet against that. You can point to Iran. You can point to the debt ceiling. You can point to whatever, fear du jour you can think of to uh, convince yourself to take action or do something to not try and participate in that because you think you're right and everyone else is wrong. But the reality is this is a very uh, the backdrop is that stocks are catching momentum and we're fighting through a lot of the uncertainty. So uh, it's yeah.
So I think one of my favorite, yeah, like a great example of this, right? Like there's all this, people always like to look at risk. And you just pointed out that there's a lot of stocks actually doing well, and we're in the middle of a bull market. You mentioned the Iranian, Israeli conflict and all that. So you would think that, like, okay, fine. Maybe stocks in the U.S. are doing fine because there's a gigantic ocean that separates us from the Middle East. But if you're closer to the action, things might not be as good. But the stock market in Israel, do you know how it's done since the start of the
Didn't they just make like a new
Israel-Iran
all-time
conflict?
high? Like, aren't they like?
Yeah, it's up 14% since mid-June. Up, right?
Yeah.
Like that's not what you'd expect at all.
No. I mean, and that just plays to the bigger theme of overseas equities doing really well in 2025, right? If you look at the last couple of years coming out of the 22 sell-off, the U.S. led the way, but we're seeing international equities lead the way this year. They're doing great. And Israel's a really interesting example of that, especially with all the geopolitical stuff happening in their backyard. But that's how this works. I don't know how many examples people need. Time and time again, just stocks blowing through the headlines. They're forward looking. The market is smart, and the market is the collective knowledge of a lot of really uh, of millions of different inputs essentially. So all great things, and we're appreciative of our clients for hanging in there and staying fully invested through a lot of this, even though the headline noise is still unsettling, even if we know to ignore it. But on that note, Andy, I know you got an email, and I've gotten a couple questions the last few weeks about not directly tied to market timing or what's happening now, but like, hey, at what point do I need to revisit my the risk level of my portfolio? And sometimes it's tied to, hey, I'm nervous about what's happening in Iran. I'm about to retire, or I'm about to make a big purchase, or my life circumstances are changing. But like, let's talk through some of the factors, well, whether it does make sense to make an allocation change or a risk change based on that. And if not, like, what are some of the drivers of a risk change?
Yeah, definitely. So I mean, I think it's so important that you strike that risk and return balance. And there's a few things that go into it. For one, I think you need to look inward and ask yourself, like, how much risk am I comfortable taking? Like if I see a scary headline, am I going to lose sleep at night knowing the way that my portfolio is invested, right? Am I going to, possibly take action and just, go to cash when the stock market drops 5, 10%, whatever it is, right? If that's the case, then right? I'm not saying that anyone should be 100% all in or 100% all out of the market, right? Most people are gonna be somewhere in the middle of that spectrum. So I think long and hard about what you can stomach, and think especially long and hard about what you can stomach when things are bad, right? Because we oftentimes make that decision when we're calm, when we're in a neutral state, right? We're not going fight or flight with our bodies, and then all of a sudden there's this big, you know, it could be a war, it could be a market drop. There's some sort of stressor, right? And then we're going to feel really anxious, and we're going to make different decisions maybe in that state. So really think long and hard about when you are going to be stressed. What kind of decisions are you going to make, and maybe you can look back at your past decisions, right? So that's one really key part. The other thing is really going to matter here is that ability, right? The ability piece. So based on the amount of money that you've saved, what your nest egg looks like, how much you plan on spending, what your plans are, for your money, that'll really dictate also what you can do. So maybe you're, you know, you don't want to take on that much risk, but for your spending needs, like you feel like you have to, and there's a mismatch there, right? So that's gonna be something to consider as well. And then the final thing is like, what are your goals, right? Like what are your objectives? So if your objectives are really modest, you're just trying to like live, a pretty modest life in retirement. You're frugal, maybe you can be a little bit less aggressive. Maybe you don't need quite as much. But if you've got these really high dreams, right, and your goals, we might need to make some different choices. And some of this even comes down to non-investment things. But I think that's the piece that normally, you'll notice what I didn't say. I didn't say the U.S. bombed Iran as a piece of that, right? Like I didn't say that like, there's inflation expectations or something like that, right? These are things that are just going to be factors driving the stock market return. But your risk level of your portfolio, it should be planned out really carefully ahead of time. So when, and not if, when we do get hard times in the market, you already have a plan for
I
that.
think the most important thing you said there, to sum it up, is making this decision from a position of strength, meaning not in a
Mm-hmm.
panic, in an emotional state. And that's why I can't even count how many times when markets have been rallying or there's been low volatility and there's a level of complacency. Those are the times we're pounding our fist on the table to clients saying, hey, let's let's revisit this. Let's talk about, hey, here's your risk level now. Here's how the portfolio is allocated. I know things feel really good today, but let's think through future scenarios where there might be bear markets, there might be drawdowns. Like, this just still makes sense. And to make that decision when you're in that calm state and when you're not in a panic, and then go from there. And that's a lot of financial decisions you make are tied to like getting that feeling of freedom and peace of mind. And in timing that conversation around risk is incredibly important when you think about that. You don't want to be, because like the worst scenario, you don't want to be that person calling your advisor in February of 2009, a month before the market bottom, saying I can't take this anymore, get me out of the equities and put me in cash for now, because we all know how that works. And so that's the kind of message that we need to deliver to clients in these windows of time, even when we can't give exact figures around when the crisis of the day is going to get resolved, or what it means, or what the market might do in the next few months. But just to really hammer home um, the intelligence of the markets
Yeah.
and the long
Yeah.
term piece of this.
It's funny you say the word intelligence there, because psychologists have studied, they've done IQ tests on people when they're in just a normal steady state versus when they're actually in like a stressed state, right? And they do better on the IQ test when they're in that normal state. They perform worse on the IQ test when they're stressed. So keep in mind, I totally agree that any changes need to be made from that position of strength, because you are yourself then. You're actually dumber when you're stressed out, panicking, right? That's probably why you're panicking, right? Your brain, and it's not because you're actually dumber. It's because the stress response in your body is keeping your brain from thinking the same way that it would if you were otherwise much calmer. So I think that's something to keep in mind too, is like, imagine yourself into the future, back when you're on steady ground again. Are you going to be happy you made that decision?
Yeah, great point. And we'll obviously be continuing to see what happens throughout this week, leading into our next episode for next week. But is there anything else we need to close out with? I know I hit you with a massive curveball to kick things off. You've already returned the favor several times, so I'm going to let you do it one more time.
Well, let me ask you, what are you listening to this summer?
What am I listening to this summer? I'm on it's a little bit of a cop out, but Led Zeppelin is on my revolving. It's pretty much it's the top of the playlist today because a new documentary came out in the theaters a couple months ago, Becoming Led Zeppelin, where they follow the band from their inception through pretty much their first two albums. So the big, long-time Led Zeppelin buff. Uh, I've been, I thought it was really interesting. It was a lot of behind-the-scenes stuff that wasn't even in some of the books they wrote about them. So that's what's on the playlist, and you can't go wrong. So I know it's like one of those top bands everyone loves, and it's a cop out. It's not this new indie artist that I have to dump on everyone, but due to the documentary, which I encourage everyone
Yeah.
to check out if they're a rock fan, that's what it is.
I thought it was going to be Miss Rachel, so far
No,
better than
I'm
Miss
done with
Rachel.
Miss Rachel. Having two girls under two, I'm Miss Rachel out, and going from Miss Rachel, which is really just corny children's music, everything sounds like heavy metal compared to that. So even the softest rock sounds like Metallica. But no, Led Zeppelin it is, and I'll let you keep listening to Katy Perry and Lizzo, and we'll take it from there.
Look, there's a time and a place for all music.